Well, it's been quite a tumultuous week this week. It's been another week in which politics has ridden roughshod over anything that we get in terms of economic data. Obviously, the initial crisis point in politics was Italy, and perhaps it's worthwhile looking at what happened with Italian two-year yields and also thinking about the broader ramifications of what happened here. We went into a blind panic on Tuesday without any shadow of a doubt. We took yields up by more than 200 basis points. We are settling the week at a much lower level. But there needs to be a little bit broader thought about what's been going on here, because this is not just about Italian political risk. One could easily argue that perhaps this was a very severe overreaction amid concerns that Mr. Savona, who was originally proposed as the finance minister, was such an strong proponent of leaving the EU and also the euro that that was where the big risk lay. The fact of the matter is, of course, that if you look at the latest opinion polls, more than 2/3 of the Italian public want to keep the euro, and only 25% think it would be a good idea to leave. So we were mispricing that. But what else does it tell us? Because it really tells us about a number of other things. The first one is this a very good example of lack of market liquidity? Now, one can argue that obviously what the ECB has done in terms of its quantitative easing program has robbed the market of a lot of liquidity. However, I think there are broader terms, because if one looks at what was going on in other markets, there were similar displays, if not quite so acute. So really what it's telling us also is that there isn't really a market-making function in markets anymore, and that as soon as we hit a patch of trouble, be that politics-related, or indeed perhaps in the future more acutely related to the exit from ultra-accommodative monetary policy, there isn't anyone there in the banking sector to play the role of intermediary. And this is largely a function of post-GFC regulation. And it's probably one of the reasons why we also have had this week these proposals from the US Federal Reserve to actually start easing back or clarifying where we're going to stand in terms of the Volcker rule. The most important part of that really is that the way that the Volcker rule is currently written, it's actually very nebulous what is proprietary trading activity and what is market making activity, and hence given a very legalese type perception of this thing, the market makers basically don't make markets, they simply broke. And in the situation where you basically just get a whole load more sellers than buyers, you get what we've had in Italy. Are our problems with Italy gone? Definitely not. We've settled things down a little, but the new government has basically a lot of proposals, particularly in budget terms, that are going to create a lot of conflict with the rest of the EU, particularly Brussels and Berlin. And so this one is going to be staying on the back burner. But for today, obviously, we've had the vote in the Spanish Parliament, or we are going to have the vote in the Spanish Parliament, at which Mr. Rajoy will be unseated. The concerns in markets there really have not been quite as acute. There has been some widening in Spanish bond yield spreads, but nothing as acute as Italy, simply because any incoming government will probably be only a caretaker government ahead of new elections, and secondly are unlikely to make any proposals that kick against the bricks in Brussels. Now, the more important aspect to all of this is the way that the markets reacted elsewhere to what was going on in Italy, and perhaps most notably how we started to push very sharply back on expectations that the Fed will be hiking rates in June. As you can see, just before the current turmoil, we were pricing in a June rate hike at 100% probability. We were as low this week as 62%. We've recovered somewhat. But it flies in the face of reason to actually assume that the modus operandi of the past 5 or 6 years, that central banks will come in and bail markets out at every opportunity, is still in operation. The Fed wouldn't have been tightening on this very gradual and very autopilot course if it actually was looking if it was concerned that there might be some market turmoil which it would need to intervene with. So we've still got this mispriced, and it looks even more mispriced when one starts to look at some of the information that we've had out of the USA. The manufacturing surveys and indeed the regional services surveys have all been universally strong. And this week we had the Beige Book, which quite remarkably, in all my 33 years, I've never read a report quite like this in describing US manufacturing. They said manufacturing shifted into a higher gear, with more than half of the districts reporting a pickup in industrial activity and a third of the districts classifying activity as strong. Fabricated metals, heavy industrial machinery and electronics equipment were noted as areas of strength, and rising goods production also led to higher freight volumes for transportation firms. So that brings us to the final point of the week, which is obviously that Mr. Trump has decided to impose those steel and aluminium tariffs on the countries in NAFTA, i.e. Canada and Mexico, and on the EU. To my way of reasoning, this is a classic example of the English expression, if it ain't broke, don't fix it. But he is starting, obviously, down a path which is now not just trade tensions, but a trade war. It will be interesting to see how the EU responds. One would expect them to attack those, particularly those areas which will be sensitive in the midterm elections in November. And the real danger is that we get into a spiral here. The biggest point, perhaps of all, is, of course, that Mr. Trump and his team's unconventional tactics, whereby they they constantly threaten people who they're supposed to be negotiating with, is actually going down extraordinarily poorly, not only with the NAFTA countries, but also with the EU and indeed China. And it's here where we have one of those danger risks that basically he goes a step too far and we escalate into a situation where we do get into a proper trade war, which is actually very sad when one actually looks at the world economy at the moment, because it's actually in a very, very good place. And Mr. Trump looks like the man who wants to destroy it.